Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Before getting into today's discussion, I'd just like to remind you all to hit the like button and don't forget to subscribe so you can get the latest episodes as soon as they're available. Okay, Jan, we'll start with you this week because we missed you last week. And US rates markets, well, like everywhere else, have been very volatile this week. But since we last spoke to you 2 weeks ago, I think it was now, you've updated your, assessment of fair value for US Treasury yields, both at the front end of the curve and further out. So do you want to kind of just quickly talk us through what your latest thinking is for those?
Absolutely. So we had this very bearish stance, particularly in the front end belly of the curve, where we imagined a flattening would be led. And this is more like a context of our thinking over the past 6 to 9 months, where we figured with the Fed coming in more aggressively, as inflation proves to be not as transitory as the Fed thinks, the market would have to price in a lot more reaction from the Fed. And that's exactly what happened. We saw kind of like the belly leading the way, and forwards repricing very, very high in expectations of a very hawkish Fed. And do we think that's going to happen? Yes. But at this point, a short view really takes a stance of trying to fight that pricing and assume that the Fed is going to go really, really a lot more than kind of like a lot more what's in the market pricing now. And that seems pretty hard to us. And not only that, if the market is expecting say a series of 50 basis point hikes and the Fed to really step in, tighten to rein in inflation, we think that should lead to, as the next step, being the market's pricing in a cut in the on the curve, lower yields from call it something like 5 years on, where as the nature of boom and bust cycles, this looks like a supercharged one. So it would have 2-year yields lifting up, and then the 5-year point of the curve outperforming yields lower because the markets are going to need hard proof to believe that the Fed can soft land this. So with that, we are still slightly more bearish on the front end, the 2-year point. The last couple of days, of course, have been really sharp too. So that kind of brings us close to our estimates for year end. And for the remainder of the curve, we are more or less in line with forward. So for the first time in a while, we are more neutral treasuries and curve, and we're going to be looking for any opportunities to actually start buying into this type of sell-off. But that's not a story yet. But we're going to get to a point, as I've been kind of alluding in the last couple of podcasts, to the second half of the year, where maybe even steepening comes back into the picture, particularly if we start seeing early indications of data maintaining its robustness. With that in mind, I'm just going to quickly finish that. We took out our front-end trade, so we had a short August Fed funds view in anticipation that the market could price in a couple of 50 basis point hikes. That's exactly what happened. But now with the market at kind of like 5 hikes by August, we think that's the right amount. They're going to announce quantitative tightening, which could come in as a substitute for rate hike, possibly, maybe not. But on the other hand, we also have a set of data that's coming up, and should the data come weak, then the Fed could decide to maybe do 25, 50, 50, 50, and then that contract only covers 5. So 5 seems a fair value. We're taking that off. It worked out pretty well for us, and we're going to be looking to kind of re-enter strategically and more tactically as the curve shifts itself over the next couple of days.
Thanks, Jan, and well done on that call. So moving away a little bit just from curves for the second and sticking with the Fed, because it's that time of the month again where I get you to talk about payrolls, knowing that the data is probably going to be released before most of our listeners listen to this, unless they're super eager and did as I said at the beginning and have subscribed to the episode, so they get it in their inbox straight away. But yeah, the likelihood is most people will be listening to this over the weekend, if not later. So we will have that number. But let's talk more broadly, I guess, in the sense of, in the context of the Fed. And I'm wondering really here, what kind of a number you would need to see, do you think, to really shift the needle on that debate in terms of kind of 25 versus 50 basis point hikes? And how does that fit with our expectations, I guess. Also in light of today, we're recording this on Wednesday, so today's ADP data that just came out pretty much in line with consensus.
So the needle is looking closer to 50 than not, I have to admit. Our in-house forecast is for still 25 basis points for the rest of the year per each meeting. So that brings us to 7 total at 25 basis point increments. But I think the risks are certainly skewed to 50 basis points with the uncertainty around Ukraine, around China locking down again, inflation prints coming very, very heavy. And NFPs are also one part of the puzzle. Chair Powell in his press conference was talking about how unemployment's unsustainably low. So at this point, as it's almost kind of in a Machiavellian way that they would rather see unemployment tick a little bit higher, because at this point, the growth side of the picture has been confirmed. The full employment mandate has been met. And they believe that where we are right now as an economy, the labor market is just too tight, and what we're seeing is added wage inflationary pressures there. So they would actually like to see some weaker payroll numbers. They would like to see a little bit higher unemployment compared to where we are. That being said, if we get a strong NFP, that the implication to me is no different than getting a strong inflation number, because they know that this has been feeding through to the wage side of the inflation equation, and they do not want to see that. We have been witnessing a shift from goods into services. This would be a large component of that shift of goods inflation to services inflation. But that was, on the flip side, that was also one of the reasons, the NFPs, why we took out our trade, because our economist has 200,000 forecasts for the jobs number for this Friday. That's way below the 500K consensus. So if we have a weak set of NFPs, and if we have, say, core CPI coming a little bit slower, then the Fed could start asking questions. Maybe we can do QT and 25, and then reevaluate after that. So with that in mind, and with the kind of like the QT in the picture, we figured now is a good time to take off chips. But the NFPs will be important. I'm starting to equate them more to similar to a mini CPI print, as opposed to just the jobs number that we should be looking at.
Yeah, that makes a lot of sense. Thank you, Jan. All right, over to Europe then, a place where we've seen lots of inflation today. But before we get there, I've asked you the same question on this podcast for the last 2 weeks, and now I'm very excited to ask it and know that you have an answer. So Giles, yields have risen again a lot this week. We've gone straight through our forecast of 0.5% in 10-year bonds. You've been saying for a couple of weeks now that you think there's still further to go. How much further is there to go?
So I'm going to make everyone wait for it with the drum roll. No, the answer is not as far as it seemed when I started writing it, because we've had such a remarkably volatile time in markets. I mean, it's really been incredible, hasn't it? The answer to your question, the one that you're looking for, Imogen, is 1% for 10-year bonds, or is the nice round number that we have fixed our sights on for, basically for this year. Now, at the rate we're going, it sort of feels like we might get there this month. I mean, not this month, we're on the 30th of March, but you know what I mean, in the next few weeks. But no, I mean, in all seriousness, I think that abstracting away a little bit from the extreme volatility that we have had, and just focusing on what we think matters for the longer term. Clearly there are two things that are in play. One is this higher inflation environment, and perhaps to a certain extent concerns about how that might sort of morph into concerns about slower growth and therefore lower inflation going forward. Okay, so that's the first aspect, and that's the kind of macro analysis, and that's really what drives, I suppose, your background expectation about the demand schedule. That is, how willing the investment community, in its broadest sense, will be to buy bonds. Right. The other point is that this week PEP ends, and we go on to this kind of declining schedule for QE. And the pretty strong base case is that we will not have any more net QE by the summer. All right, so this is ending pretty quickly, and that's going to leave a very big gap between supply going forward, after taking away the kind of price insensitive demand of the central bank, and demand, given where demand was. And obviously we have already been seeing the transition from pricing in a QE world to pricing in a post-QE world. And our judgment is that we probably should be taking into consideration upside risks to around 1%. But I would stress that we see the risks around that to the high side in yield terms. So supporting that analysis, we thought very deeply about what banks are doing, what insurance, pension funds, what the foreign sector is doing, and I mean, I think you can see all of these guys buying more. Obviously, as prices fall, yields go higher. Probably led by the foreign sector that has been such an important seller up until now. Nonetheless, to plug the gap will still require, we think, a further concession. Unless, of course, something happens about the inflation environment which upends the sort of basic, this basic sense that we have at the moment, which is that the market is not set up naturally as it might have been in 2019 when everyone was worried about low inflation, and us being kind of sucked into this Japanification kind of low inflation equilibrium. The market isn't in that sort of mindset at the minute, and so it's not anywhere near as well set up to take down this big step up in supply. That's the bottom line.
You mentioned it kind of at the beginning of what you were saying, but how does this significantly higher yield view fit with I guess the risks around the growth outlook? We've heard Lagarde today sounding a bit more dovish perhaps on the kind of, or a bit more worried perhaps about the growth outlook than she did at the meeting, and that kind of echoes what we heard from her at the ECB Watchers conference. But then I guess against that, we've obviously had huge upside surprises in regional or national euro area CPI data today, which suggests that the euro area print itself is going to come significantly higher on Friday. So how do those two kind of fit together in your mind?
So I think that you fight the adversary you have in front of you, which is inflation, and it's as simple as that. If you try and central banks like to think a year ahead, 18 months ahead, because that's what they think their policy lags are. But at this point, they've been wrong for that long. Inflation doesn't seem to be coming down. And I think that the confidence that it's going to come down far enough, quickly enough, given how high it is, cannot be high enough for them not to act. So I think quantitative easing, very strong base case that it ends in Europe. Elsewhere, they're going to have to get on with rate hikes. And that also that includes Europe. But we haven't changed our view about when that starts or how aggressive that needs to be. But certainly, and again, I'm going to repeat. I think that for investors, the big question is about, is now the right time to be buying a lot more fixed income? And I would say, look at the inflation figure numbers. Yeah,
that makes sense.
So okay, now I'm gonna bring it back to you now, because it's not just them that has been more hawkish about about growth risks. What have we heard? What's the changing message from the Bank of England this week, and what do you think about sort of further up the curve?
Yeah, I guess. Well, what we've heard from the Bank of England this week hasn't really been a changing message, although you might have thought by looking at the market reaction that it was. We heard from Bailey on Monday, speaking with Bruegel, and he too kind of, I guess, reflected what we've heard from Lagarde over the couple of weeks, and just what we heard in the minutes from the Bank of England meeting a couple of weeks ago, that they're perhaps more concerned about the downside risks to growth, or the potential downside risks to growth. Bailey repeated, and Broadbent today also repeated, this kind of unprecedented shock to personal income in the UK, and the impact that will have on consumer confidence and growth down the line. But it wasn't really a new view, although, like I say, the market reacted as if it was. But it was really, to me, just a reiteration of what we heard in the minutes a couple of weeks ago, perhaps slightly more dovish and stressing those downside risks to growth than the minutes, but really did nothing to change our view. In fact, just reinforced our view that we have had for a long time, that only some further tightening is required, and by that I mean most likely a 25 basis point hike in May, and then we also have in our forecast a 25 basis point hike in August, although if you talk to Ross, he will tell you he doesn't think that is 100% nailed on. So we've kind of got maybe 2, but we're not even 100% convinced of that, compared to the market, which is looking for 3 25 basis point hikes between now and August, and then an additional 2 by the end of the year. So that front end of the sterling curve, like it has elsewhere, has been very volatile in the last couple of weeks. But really, if you look at the pricing shift since the the dovish Bank of England hike a couple of weeks ago, Bailey this week, and then where we are today, really the market has taken out maximum about 20 basis points between now and August. So we still think that there's much further to go. I guess the question now becomes around what will the trigger for that be, and perhaps the more we shift in the direction of 50 basis point hikes from the Fed, it might become more difficult to fade that in the near term. But it certainly looks like the market, just like it has in Europe, really in the UK, has priced in much too hawkish a reaction function from the Bank of England.
Okay, so does that add up to a big curve steepening then? I mean, it sounds like you're positive on the front end, and we have supply kicking off again next week after a pretty dry period. Now, how does that all add up for you? Is it straight as simple as that?
Well, yes, kind of. I mean, yeah, like I say, we're pretty positive on the front end. Listeners will know that we've been more bearish further out the curve. Similar to the story that you've gone through on the European side, Giles, we have this pickup in supply, and in the UK in particular, it will kick off next week after a couple of weeks of fairly limited supply, and that, although that headline number for gilt supply for the year ahead, as we discussed last week, is lower than we'd expected, that shift versus last year is still pretty big. And not just that, but actually the next quarter, which, as you said, begins next week, should be fairly long end heavy, we're expecting. We get the calendar tomorrow, so Thursday morning, so any listeners will have the luxury of having that already. But what we know from the consultation earlier this week with the DMO is that there seemed to be strong consensus for both syndications to be on the linker and nominal side of reopening of the 73s. So although supply isn't going to be huge this year versus expectations, it should be pretty long end heavy, I think, over the next quarter, and that too should add to our sort of bearish long end and steeper curve views.
Okay, well, I think that brings us to the end of this week's podcast, doesn't it? So I think, Imogen, you better do the honours.
I thought you might have practiced after last week.
No,
all right, then, everyone. I'll get Giles on it next week. Thank you all for listening. Thanks to Jan and Giles for joining me. And just a reminder to our listeners, if they like today's episode, don't forget to hit the like button and click the subscribe button so you can get the latest episodes as soon as they're available. Thanks. See you next week.